Good afternoon and welcome to Quicktake Stock. It's the show for retail traders eager to get smarter. I'm Katie Greifeld.
And I'm Tim Stenovic. It's noon on Wall Street, and we have a lot to get to. Let's start with just what the market is doing. Stocks are, well, they're all over the place. Look at that. The S&P 500 down half a percentage point. The Nasdaq 100 down 0.9%. The Dow, which was higher earlier as the Nasdaq 100 was as well, down about 0.1%. The focus, of course, this week has been on tech stocks, as both the Nasdaq Composite and the Nasdaq 100 entered a correction, declining 10% from recent highs. Well, the Nasdaq 100, it was down more than 2% earlier in the day. It erased those gains, those losses, excuse me. It moved into the green. Now it's back down. We're going to have much more on the markets in just a few minutes, but we got to talk about Netflix, Katie. It's having the worst day in more than a decade after first quarter subscriber outlook. It missed estimates. The worry here, of course, is over slowing growth. Roku and Disney also taking a hit. We're going to have much more on that with Tuna Amobi from CFRA in just a minute. First, though, speaking of entertainment, of streaming, Katie, you've got your eye on a meme stock. What's going on with AMC?
There's a lot going on with AMC. Honestly, it feels like shares have totally deflated. So if you look at the 5-year chart, it's almost as if all of that never happened. The 5-year average price, it's about $16.38. AMC right now, it's trading closer to $17.40. So really edging back down to pretty normal levels. So it's almost as if maybe all of this was a dream. Maybe it never happened. I don't know. All I have is that chart and what it's telling.
What are the apes saying online? I haven't heard much from them.
Yeah, the vibes are not great, Tim. You can see that AMC was actually the most cited stock in stock twits yesterday. So it's clearly being talked about. You know, people are trying to pump it, not having much success. We'll see where it goes. But speaking of charts and weird dreams, we have to talk about Bitcoin because it's really falling out of bed just in the past, 24 hours or so. This is part of a broader trend, but you can see that Bitcoin, it plunged below $39,000 per coin overnight, staying around that level, still there. And that brings its total drawdown since its November highs to about 45%. It's at its lowest levels since August. So really, it feels like all of this speculative froth, it's leaving the market all at once. So really a tough couple of weeks for Bitcoin, bleeding into the weekend, which we know is a very volatile time for crypto trading in general. But Tim, like you said, the story today is Netflix. It's having an absolutely devastating day in the stock market. Of course, after those earnings reports last night, it's down about 22% at the moment. It's worst day since 2014. That brings shares all the way back to the lowest level since April 2020 in a very dramatic fashion. And I am thrilled that we have Tuna Amobi here to help us break it all down. He is at CFRA. He covers Netflix, a bunch of other stocks as well. And Tuna, can we talk about what is going on here? Is it just that Netflix is a victim of its own success in a sense, that it really pulled forward all of that subscriber growth, or what's going on?
Katie, good afternoon. No, I think there's no way to sugarcoat, those results, and the guidance that they provided was really, spooky here. So we knew that, going into the quarter, that competition had really intensified. And we knew that, the price competition was getting more and more brutal. But I think what's ironic is the fact that the U.S. market, which had concerns with saturation, and that's really the market that, if anything, had the bright spot. So internationally, there's a bunch of things going on, with different markets still, in various stages of recovery from the COVID. And the company cited, macro issues in Latin America, COVID overhang, quote unquote. So if you remember, in 2020, the huge pull forward, and then also that starting to recycle back in 2021. So the main question is, does Netflix report really raise questions about the secular growth thesis for streaming? We think certainly at the minimum it should give investors pause. We're going to hear from a lot more streamers out there, but structurally, I think what this really, if anything, at the minimum should result in some recalibration of these growth expectations and the valuation of Netflix. We don't think, one quarter makes a trend. That's why we're keeping our 12-month, that's why we're keeping our buy recommendation, bringing out the target price, and waiting to see if there is anything really structural in the streaming landscape that really warrants a more prominent shift in expectations here.
Well, let's go there, Tuna, because speaking of recalibration, you mentioned this. You cut your price target by $200 to $525 a share on Netflix after seeing these results. What are you looking for when we hear from the other companies? If there is something more fundamental happening with streaming right now, what is going to be that catalyst? What is going to be that sign that you're looking for? What do retail investors need to be watching?
I think the primary thing here is to kind of see how, other streamers are progressing with their international rollout. Remember, Netflix had a huge mover advantage in a lot of foreign markets that Disney Plus and HBO and everyone else is looking to get into right now. The main thing that worries us, frankly, about some of these markets is the price competition, the price elasticity of the product. For example, in India, the competition has gotten so brutal that Netflix was forced to take almost a 60% price cut on its basic plan, which is almost unthinkable, even a couple of years ago, in the face of intensifying competition from Disney Plus and Amazon and everyone else. So if that were to be replicated in several markets, then it kind of begs the question as to the potential timing of the positive free cash flow that they've guided to, which, by the way, we still expect them to achieve, and it will be a major milestone. But it's pretty clear that the pace of growth of subscribers is going to perhaps decelerate from here. But as long as they keep generating revenues to offset the slowdown in subscriber, I think that's why you see the pricing power still fairly steady. Despite the elasticity of demand of the product. That's something to watch with the margins, expected to kind of stay flat this year. We expect that to kick back up next year. One thing they also called out and called, Tim, if you the foreign exchange is something that the strong dollar has been having an impact on the margins. And this year is going to be a prime example of how some of these extraneous factors can actually factor into the overall outlook for margins and ultimately free cash flow.
Tuna, I want to go back to the elasticity of demand, because we did see Netflix raise the price of plans in the U.S. and Canada last week by $1 to $2. And I'm curious how you're weighing that, whether that, could boost revenue, or would that be overweighed by a potential drag on subscriber growth because it is more expensive? How are you thinking about that?
Katie, if history is any guide, I think the potential impact on these price increases on subscriber retention and churn has been somewhat overblown. I mean, they have navigated these increases fairly well. They've taken quite a few of those, about almost like 6 of those in the last, since 2014. This time around, we don't expect the impact to be any different. They're much better position from a content perspective than they have ever been. So that being said, I do believe that subscriber churn and retention will continue to stay within trend line. The main question is going to be the acquisition, and that's what they kept coming back to on the call, the customer acquisition. And that's really where I think the major challenge is to give people a reason to come back and stay on the platform. So I think the pricing power, Katie, to your question, I'd argue is still relatively healthy, thanks in large part to the huge content investments that they have made. But it's pretty clear they're going to need a lot more Squid Games or Bridgerton, especially internationally, to be able to maintain those levels of viewership. And that's really where I think the heavy lifting needs to be done.
All right, well, I still have to watch Bridgerton. Squid Game.
Pretty good.
It was pretty good. Yeah, I've heard good things. Got to watch. Squid Game was good, by the way, too.
A little violent.
All right, well, Netflix has a little bit for everyone. I think that's the lesson here, the takeaway. CFRA Senior Analyst Tuna Moby. Tuna, we love having you on the program. We'll talk to you soon. Thanks so much for joining us. Hey, let's turn now to the other pandemic favorite that just imploded yesterday, Peloton. For that, we bring in another favorite of the show, Jason Helfstein, Oppenheimer Managing Director and Head of Internet Research. Jason, we had the CNBC report yesterday. Peloton is denying it, that they're halting production. Also, we've learned that they're hiring McKinsey to look over its cost structure. Peloton yesterday fell by 24%. It's higher, though, a little bit of recovery right now. What is going on at Peloton? You've covered this for years. What's happening?
Yeah, I mean, look, we all know that there was a massive pull forward. One of the topics you talked about with Netflix during COVID, they didn't need to market. They actually couldn't get bikes to consumers fast enough, and kind of coming out of it, the demand is slower. I saw there was an article that highlighted the biggest discounts on exercise equipment, namely bikes, from other companies. So I don't think this is a Peloton issue on the demand side. We're still working off the pull forward. And if you think about it, again, if somebody's going to, whether it's take a multi-year commitment to pay, $50 a month or shell out, $2,500 or so, that's generally a high consideration purchase. Just like when you're thinking about buying a new car, you don't just go and buy a new car. You think about it, you compare, you might do test drives, all of this, right? And at one point in time, that's actually how Peloton thought about the buying experience, and that's not what happened during, at least the most of the pandemic. And so the reality is they need to go back to kind of where they started and just build customer awareness. And so look, there's been numerous reports, right? So there was a report that they were considering cutting marketing expenses. They were looking to reduce costs in their stores and kind of cut compensation. They're planning to pass on kind of the delivery and installation costs, which were free prior. And so there's just been a lot of kind of, let's say, negative news cycle, right? And so to the point where it capped off with what you talked about with CNBC reporting that they were basically halting production, that it actually propelled the company to pre-announce the quarter. So last night they came out and they said that revenues were about a percentage point below what we had them at, but in line with the street. The cash flow, the EBITDA, was actually the losses would be better, suggesting that some of the cost cutting is actually starting to work, and that connected fitness subs, however, would be about 2% less than we thought, 1% below the street, on kind of lower net ads. And so, but the reaction in the stock today was it's not as bad as people thought. And they're firmly saying that they are not halting production. I mean, they're probably slowing production because if you looked at the balance sheet last quarter, they clearly have plenty of bikes sitting and treadmills sitting in warehouses. So that's what you've seen in the stock today.
Peloton is so interesting because it feels like, I don't know, at least everyone I talk to loves the product. And full disclosure, I did arms and intervals with Cody Rigsby this morning.
Look at you, Katie.
Yeah,
not just for the show. That's like a regular thing.
Not just for the show. That's
a
regular thing.
Yeah.
There's only one in my building. And I mean, it's a bloodbath every morning trying to get on the Peloton. But that brings me to an actual question, which is who is, trying to take market share from Peloton right now? I mean, with Netflix, which we were just talking about, the competitive landscape is clear. But I mean, who is trying to, disrupt and steal Peloton's crown at this point?
Yeah, I mean, really, I think the question is really, you just made the prime example. You love Peloton, but you don't own one. You usually shared one. I have the same situation. I ended up giving up and buying a Peloton because for that reason during the pandemic. So the question is, again, with the purchase consideration, when does the suite of Netflix or Peloton content get to the point where it pushes you over the edge to say, you know what, like I need to use this equipment every day, not twice a week. So I want to have one. I want to share it. Look, there are other companies selling equipment. The ones that tend to be most successful actually are sub $1,000, and it's bring your own tablet, right? So there's just less technology in it, and so you could actually have a Peloton app that you pay the what is it now, $9.99, the small monthly fee, and then and then just bring your own bike. There are other companies doing this, but again, if you look at some of the promotions that those other companies are offering, hundreds of dollars off, it would suggest that Peloton isn't losing share. It's just the broad category is seeing slower demand. And look, it could just be that there were people who are now back to comfortable being in gyms, where 9 months, a year ago, the people weren't comfortable being in gyms or the gym was closed. So look, I think that there's expectations that Peloton will bring additional features or additional weather strength, right? And look, the challenge of doing all that while you're trying to kind of right-size your business,
Right.
is difficult. So, yeah, look, investors are trying to figure out, a year ago, people thought of this as like they're going to be the Apple of fitness. They're
Well,
gonna have
okay, so
multiple
yeah.
products.
So I want to go there, Jason, because one thing that we haven't spoken about is this being a potential acquisition target for a company like Apple. And I've seen some chatter online, people saying Apple should buy them, Apple should buy them. I got to tell you, I don't see it. Are they an acquisition target? Would Apple buy them? If not Apple, who buys them and why?
Yeah, I don't think Apple. I think the last, and I don't cover Apple, but the last big acquisition they did was Beats, and it was many years ago. So
And they
I
bought that
don't
for the
think
streaming music service. They bought that for the streaming music service, not for the
Yeah,
hardware.
but I'm just saying, but if you
Yeah.
actually think about, like, Apple generally is not an acquisitive company. They like to build things. I don't know, maybe Alphabet, right? I mean, Alphabet bought Fitbit. They have aspirations in connected devices. I don't think Google Home has been particularly successful relative to Alexa and what Amazon's doing. So who knows? Look, we are not making any prognostications on the takeout. I think the stock, from here is attractive. We did trim our estimates just to be conservative. Kind of why not? Because clearly no one's got visibility on what's going to happen in the short term. But on our new estimates, the stock is trading at 5 times gross profit. All the other subscription companies we look at trade at like 11 and a half. So, and even if you looked at the lowest valued one, it's 8 or so. So, and even if estimates are wrong, there's a lot of cushion. So, look, we think at the end of the day, Peloton will win. They're clearly going through growing pains. Again, you made the point that they're kind of reached out for some help from McKinsey. Hopefully they kind of work through some changes. But at the end of the day, to your point, consumers love the product. I think we all probably could still lose some COVID pounds. They got a little far over their skis and now they're, and if that was their fault, now this is just, consumers are taking a break from buying fitness equipment for their homes.
Right. Well, we have to leave it there, Jason, but it's great to get your perspective on this day that we're seeing with Peloton. Oppenheim Managing Director Jason Helfstein, thank you so much.